Good morning. This is Dean Tenney. I'm coming to you from my studio here in fabulous Las Vegas. We're working our way through the explication of the test specifications provided by NASA for their various exams. This installment is continuing where we left off on the Series 65. I highly recommend that you go to the NASA website. FINRA also has a link, and you print the test content so you can follow along, make some notes. And I would use these explications we do of these various test content outlines, test specifications as an intellectual inventory. So my intent is not to lecture on these subjects. We have narrative lectures for most of the stuff I'll be discussing this morning. I would refer you there for that. Here, we're just going to kind of briefly give you an overview of some of the things you're held accountable for. So let's get started. So types of equity securities, you can expect two questions according to the test specifications. So, sometimes people tell me they got, 10 questions on something. I say it's impossible because they're not allowed to go outside of the test specifications on what they tell you they're going to test you on, both in terms of content and number of performance opportunities. Now, remember, that doesn't include those experimental questions that they test for validity. But anyways, a common stock. So you can be an owner as an investment advisor representative. You can deploy your customer's capital into becoming an owner of either a domestic corporation or a foreign corporation. Now, the advantage of owning common stock, and then we'll distinguish between the two. I like to put what I want to tell you in red to distinguish between what Dean is saying and what the outline says, right? So let's see here. If somebody is worried about purchasing power risk, let me get rid of that number 2 there. Purchasing power risk. Oh, man. There we go. Or sometimes another way we might say that, the point of investing is to beat taxation and inflation. And so we can't beat inflation. Our customers actually losing money, right? Because they're, why delay gratification if you aren't going to have more in the future? And so common stock is very good for somebody who's worried about purchasing power risk or inflationary risk. Common stocks are typically going to do better than are other things like fixed income investment vehicles. Now, as a domestic corporation here in the US, they're going to be subject to the regulatory framework, and that could be helpful. So you may not be sure what the regulatory framework elsewhere in the world is, but some people have a better understanding of what the U.S. regulatory framework is. For us, mainly 33, 34. A domestic publicly held corporation has to file 10Qs, a 10K. They have to file 8Ks. So that's a good reason to buy a U.S. corporation. You also have no current currency risk in a U.S. corporation. For test purposes. I mean, they may get some of their earnings outside of the U.S., but for test purposes, you don't have any currency risk in buying a U.S. Domestic corporation because the business is denominated in dollars, dividends are paid in dollars, whatever the case may be. Now, you might want to get some foreign securities in your customer's portfolio. And why would you want to add a foreign security to your customer's portfolio as an investment advisor representative? What you're hoping is that maybe some of those foreign stocks that you own, Nestle, Sony, Toyota, Samsung, would have different correlation than the U.S. stock market. Sometimes I'll even use the word negative correlation. I'm not comfortable using that word in this regard, but different correlation. I'll just say it that way for purposes of our explanation. Different correlation than the U.S. stock market. And then remember, you have a risk here because there's a different regulatory framework than in the U.S. You're going to have currency risk. Because of the business, if they're conducting the business in euros or yen or whatever the case is, we're going to have to turn that those yens or Swiss francs or euros into dollars. So we have currency risk in those foreign securities. We have sovereign risk. I mean, maybe the country nationalizes, takes over our company, that we are an owner of in one of these foreign venues. So we have a sovereign risk. And sometimes that's the same as saying political risk. And the other thing, the easiest way for, and this is almost on every draw, the easiest way for a customer's portfolio, for us to put in our customer's portfolio foreign security and get that exposure to common stock of a foreign corporation is through an American depository receipt. I can't imagine any exam in which you aren't going to get tested about the American depository receipt. And one test question about that is it can best be described as a foreign, it's a domestic issue, right? So it's US. But, the best way to think about it, this isn't actually technically correct, but it's close enough for our purposes, a foreign security traded in our US domestic market. It's actually a US security, but I think, foreign security traded in the domestic market. When I buy an ADR, that American Depository Receipt, what I'm buying is in the foreign branch of a domestic bank. There's 1,000 shares of Nestle, for example. So this would be the Bank of New York's Geneva branch, and I'm the beneficial owner of that. I can't imagine you don't get asked about an ADR. And then the other test question, remember, is what we said, you have currency risk because, if they're conducting the business in foreign currency, for example, Telephones to Mexico is an ADR that trades on the New York. And Telephones to Mexico, they're collecting the phone bills in pesos. And when they, collect the phone bills in pesos, you got to turn it in dollars. Used to be 10 pesos, now it's 20 pesos. So you do have currency risk. So if you put that in your customer's portfolio, they're going to have currency risk. All right, so preferred stock has preferential treatment in two areas, So common stock and preferred stock. You have preferential treatment in dividends. They cannot pay a dividend to the common. Preferential treatment in dividends. Let me just label that. And liquidation. So you have preferential treatment in both dividends and liquidation. Now, the dividends you're going to be receiving are stated as a percentage of par. And so that means if it's a 6% preferred, for example, that 6% is based on par. Very important. Par in preferred stocks is 100. So, that's going to be 100 times 6%. And that means we could expect to get $6 annually per share. It wouldn't be paid to me annually, it would be paid quarterly. So if I bought 100 shares of this in my customer's portfolio, 6% is $6, 600 shares. So $600, I would expect $150, 600 divided by, the quarters. Because stocks, they pay quarterly. I would expect $600. Now, that's a fixed income investment vehicle, very important, because that $6, you're not getting more than that. You might get less. And what's important about fixed income investment vehicles, including preferred stock, remember, is that if interest rates go up, the preferred stock is going down in the secondary market. So while the issuer is going to classify the preferred stock as equity on the balance sheet, the way it's going to react in my customer's portfolio is much more like a bond, because like a bond, preferred stock is a fixed income investment vehicle. Now, in a convertible preferred stock, we allow you to switch your status. You can switch your status from being a preferred stockholder to a common stockholder. And that's going to be based on what we call the conversion price. So when it's issued, I accidentally triggered the Alexa cancel. I accidentally triggered her by that. I don't know why. Anyways, conversion price would be based on par. And let's say the conversion price is $25. I'll just make that up. So very important to know how many shares you can get if you convert your preferred stock. As you recall, in fact, let me get a different color because you're going to may encounter at least one of these. So let's just distinguish that from here. And so we need to know how many shares we can get if we turn in our preferred stock. And the way we're going to do that is we're going to take par. Again, let me get a different color here. There we go. Remember, par is $100. And we're going to divide by the conversion price, which in this case is $25. And we get, very important, the conversion ratio. So in this example, the conversion ratio is 4 shares. And so that means, if we choose to, we can give the word for this is tender, but we can tender our preferred stock, and for each share of preferred stock, get 4 shares of the common. So the conversion ratio is 4 shares in the common for every share that we have of preferred stock. Now, again, I don't think it would be a bad draw here as we just go up here again and just look at the number of performance opportunities we're looking at here. And we're looking at only 2 performance opportunities. So I think that's the challenge on 65, right? You just don't know how much depth you want to spend on things for like 2 points. But I'm not going to calculate parity here. Calculate parity. And to be honest with you, I don't even think I have the convertible lecture in the playlist for the 65. So on this and options, there's some things that we haven't done. So I'm not going to actually calculate parity and determine, for example, if I put this in my customer's portfolio, what would I end up paying for the stock if we convert? I'll leave that to you. If you choose to want to do that, there's a lecture for you called Convertibles. I don't know if it's in the 65 playlist, but you can find it. It's a 30-minute lecture just on convertibles. All right. But I would definitely know, again, the conversion ratio. I think that's going to be more likely, higher probability that's what you're going to get. All right. So employee stock options, these come from the corporation to their employees. And there's 2 versions of this. And what you've got to be able to do is contrast an ISO. Let me get my different color here. An ISO, which is qualified. I'll tell you what that means in just a sec. And in NCO, non-qualified stock option. With the ISO, you have a tax advantage because when you convert the employee, this is for higher end employees instead of stock options. When you convert, the gain is going to be taxed at long-term capital gains. And when you are getting an NSO, non-qualified, that's what it means, doesn't qualify for the long-term capital gain treatment. The non-qualified stock option, when you convert, or another way to say that is exercise. You exercise. I mean, that's even actually better test terminology. Exercise. It will be at ordinary income, the taxed at ordinary income rates. All right. Now, when you get stock directly from the issuer, whether it's the exercise of your stock options from the employer, or whether that's, you got it in a private placement, it's basically stock received directly from the issuer. What we mean is you didn't get this in a public marketplace is what we mean. And so if you didn't get this stock in the public marketplace, the reason we call it restricted, because it has a restricted transfer. You have to hold the stock for 6 months. Now I'm dating myself. I go way, way, way back. I go back to the days when there really is stock certificates. I can assure you there still are stock certificates. You may at this point be able to go through your whole career and never see a stock certificate. But I will assure you they do exist. And in the old days, when you got stock directly from your issuer, the stock certificate would have a nasty legend on it that would say stop transfer. And if you came into my brokerage branch office and you hand me the stock certificates, I'd say, ooh, it has this nasty legend on it that says stop transfer. And that legend that said stop transfer was in red letters. And so sometimes we refer to this as red letter stock or legend stock. It's stock that you got directly from the issuer. Sometimes we refer to this, and I joke this is it's hard, the test, because it's like learning a foreign language, right? They say when you dream the foreign language, that's when you know it. So I guess when you have your first dream, that's when you know this. So there's a lot of words for this restricted stock. Restricted transfer is why we call it restricted stock. We still sometimes refer to this as legend stock, because in the old days it had a legend that said stop transfer. And in the old days, I'd say how long you've had it, because if you had it for the right period of time, I'd say, oh, let's send that into the transfer agent, get those nasty red letters removed. So legend stock, red letter stock, unregistered stock. The biggest test point here is that this kind of stock has a 6-month hold. That's the biggest potential test question. All right, so we said in that category that we just finished up here, just going to get a review. And this is the challenge. I think of the 65 as kind of like a baby 7. There's a lot of stuff, right? So we just don't know which of these 2 questions in this test specification you're going to get. And so, you got to be prepared for whatever 2 questions you get there. Now we have 3 questions in this next discussion about shareholder rights. And one of the rights you have is a right to vote on matters pertaining to the corporation. And in the corporate charter, we're either going to have statutory voting or cumulative voting. And prior to 1934, you get a lot of questions right by covering up the screen. Are they asking about prospectuses? The Paper Act, that's 33. Are they asking about people and places? That's 34. They were companion pieces of legislation. Congress knew when they passed 33 in December, they're going to come back and pass 34 in January. Please note, President Roosevelt, all that legislation, include this, was called the New Deal. He made the first chairman of the SEC, Joe Kennedy. And his New Dealer friend said, how could you put, a fox in charge of the hen house? And he said, who better as a gameskeeper than a former poacher? We were just talking about foreign and domestic securities. I'm a big fan of our current chairman, Gary Gensler. He's a former participant in our industry, kind of like Joe Kennedy, right? He's not an attorney. He's a former Goldman Sachs partner, and he understands the securities industry. I'm coming to you, in September. He just published an op-ed piece about how people don't understand when they're buying Chinese stocks. They're not really buying Chinese stocks, that they're buying shares in a holding company, the Cayman Islands, that has an operating agreement with a Chinese stock, and he thinks that doesn't comply with the U.S. regulatory framework, and said, listen, you got to clean up your Chinese companies, your audits, procedures, and comply with the domestic securities laws of the United States of America if you still want to be listed here and trade here. So anyways, it's a good read. Find it, Google it. It's an interesting read. Basically, he was trying to set out the risks that we were talking about earlier about these foreign securities, are different than what you might think you own, right? Anyways, prior to 1934, we would have shareholder meetings at 11:59 p.m., and you have to be present to vote. And we'd have the shareholder meeting at Alcatraz Island, for example, and there'd be a thug on the dock, and he'd ask you how you're going to vote. And if you didn't come up with the right answer, you wouldn't be able to attend the meeting. So one thing 34 says is you do not need to attend the meeting to vote your shares. You can vote by proxy. So that makes it a little more fair. Now, statutory means that, kind of boring, right? If it's statutory voting, I have 100 shares, I have 100 votes. And if we're voting on 3 board seats, I vote 100 yes, no, 100 yes, no, 100 yes, no. Whereas if it's cumulative voting, we take the number of shares I have. In my case, 3 board seats, I have 300 shares. I can spend them in any fashion I'd like, right? So cumulative voting protects minority shareholders a little more because on any one thing, they have more votes. Now, what's been showing up in the 7, this is the 65 test specifications, but recently people have been seeing questions on the FINRA exams about super voting shares. And that's simply a share that has more than one vote, and that's typically held by insiders. Now, another right you have, besides being the right to vote on matters pertaining to the corporation, let's just put that, that's what that is, your right to vote on matters. I'll put corporate matters. And shares vote, not people. What I'm trying to distinguish there is that, you know, if I have 5 million shares and you got 100 shares, I got 5 million votes and you got, 100. So shares vote, not people. Now, another right you have as a shareholder is your right to maintain proportion ownership, and that's called your preemptive right. And I don't know if you participate on our community page, but if you do right now, I have an example up there on a rights offering. So your preemptive right is the shareholder's right to maintain proportion ownership. And that is typically done through a rights offering. And so, if I have some stock in your portfolio and the company says, Dan, we're going to be doing some additional equity financing, your owners, the existing owners like your client, have a right to maintain their proportion ownership in the corporation. So we're going to be doing a rights offering. And so, for every share your customer has, you have a right. Now, what you got to know about rights is rights are short term. It makes sense because, the company wants the money. Let's just put this here first. The first right of refusal. The issuance of new shares. And that's going to be a rights offering. Whoop, looks like I got a typo there. They're short term and they're exercisable. Let's put 1 and let's put 2, exercisable below the current market price. That's giving you an incentive to participate, right? Because, it makes sense. We're going to first go to our shareholders and ask them if they'd like to maintain their proportion in ownership, right? Because, they're the most likely candidates to provide us the financing is our existing owners. Now, we can't, very important, we can't demand that they participate in the rights offering because the shares are non-assessable. Boy, I'll tell you, a lot of legal terms that show up on the 65. And what that means in, English, simple English, is that the corporation can't demand additional capital from you. They can ask politely, right? They can say, for example, the example I have on the community page is EasyJet. EasyJet is an airline company, low-cost airline company, and they're looking to raise $1.7 billion from their existing owners through a rights offering. But if I call you and say, hey, do you want to participate? You can say yes or no. If it was accessible, that means the capital call is mandatory. So, small privately held businesses, sometimes there are mandatory capital calls, but you're never going to have a mandatory capital call in a publicly held U.S. corporation. Anyways, that's what we mean by that word non-accessible. So, they can ask politely, but they can't demand that you participate in this. By the way, the state administrator likes that word too, because he's concerned about investment opportunities where shares are accessible, where there's mandatory capital calls. Liquidation is very testable. And liquidation, remember, in terms of common stock is last in line. I'll do this from junior to senior. This is very testable, high probability. I can't imagine that you aren't going to get asked about this. So the most junior thing you could be owning in liquidation, a corporation liquidates, right? Capitalism without failure is kind of like religion without a hell. So it'd be common stock is the most junior, then preferred stock. Remember we said that has preferred treatment. And then, senior to the preferred stock would be unsecured debt. And then the most senior thing would be secured debt. I can't imagine you're not going to get asked on your exam to either put this from junior to senior or senior to junior. I'd be prepared for priority and liquidation preferences. I would definitely be prepared to do that. Now we have a theoretical liquidation value of the business because we don't assume we're going to liquidate. But that theoretical liquidation value is known as book value. So, we have book value. I'll just give you an answer set here on the test. Book value, market value, par value. And depending on what they're asking you would depend on the appropriate response. If they're asking you the theoretical liquidation value of the business, you would say book value. If they say a supply-demand relationship in the secondary market, that would be market value. Sometimes we refer to market value as market capitalization. What is the market capitalization? Now we're coming up with, I'm just joking here, but they're talking about a new category called mega cap. Mega cap would be over $1 trillion, and market value. If we take all the shares of Microsoft or Amazon or Google and times it by the number of shares of outstanding, we would come up with $1 trillion. So that's just a joke. For now, but you never know, right? We did already talk about resale restrictions. We said there's a resale restriction on restricted stock, right? You can't resell it in the secondary market until you've held it for 6 months. So there may be a 6-month hold. And then there's also this thing about people who are insiders of the corporation who own control stock. And if they own control persons and control stock, the stock they own, control person stock, is called control stock. And there's different rules that apply to them. So we have what's called the short swing rule. And that just says if you're an insider or control person, you have to avoid a short swing profit or loss. Again, that's 6 months. So that shouldn't be something that's hard to do. But the short swing is 6 months. If they buy it in the secondary market. So if I'm an officer, director, or principal stockholder, I go into the secondary market, I buy the stock. If I sell it within 6 months and I have a profit, I'm going to have to disgorge that back to the issuer. Some stocks have dividends, some stocks do not. And, here the question is, and people get confused about this, is if you own the stock, you don't have a right to a dividend. You only have a right to a dividend if declared. If declared by the board. And, we associate dividends with mature, stable companies. The only two ways you're going to make money in an investment of any type, including stock, is income stream and or price appreciation. And so we associate dividends with mature, stable businesses, mature, stable corporations. We wouldn't expect a growth stock, for example, to be distributing to us a dividend. So we associate this with mature, stable corporations who have excess earnings. The board decides to say, what should we do with this money? We don't need all this money to run the business. Let's declare a dividend. Now that's important because as a practitioner, as an investment advisor representative, maybe I do want to have a portfolio that has some dividends, stocks with dividends, and maybe some growth stocks. Maybe I want to mix that up a little bit. But a couple points here. You don't have a right to a dividend. You only have a right to a dividend if declared. Now, you should definitely be able to do on your exam current yield. So current yield is where the company pays a dividend. I'll just make up one. This is Bank of America's quarterly dividend. So Bank of America's quarterly dividend is 21 cents. So can you see the trick already? I have to times that by 4 to come up with the annual dividend before I do the current yield here. So 21 times 4, 84 cents. And current yield is what an investment pays you divided by what it costs you. So we're going to take the 84 cents and I'll just real quickly get the Bank of America stock price here. BAC. And it's $40. So if we, what it pays us divided by what it costs us. And so the current yield right now, based on today's price, it could differ depending on what you paid for, but 84 divide by 40. Looks like about a 2% yield, 2.1. You know, it's not a bad yield. I might consider such an investment. So should be able to do current yield based on those dividends. So 3 questions here, and we'll call it a day in terms of this explication. Methods to use the value of equity securities. Again, I would expect you to see this as an A, B, C, D. I mean, they don't really have time to be messing out too much, but technical analysis, what we're looking at is the supply of the stock versus demand for the stock. Now, I highly recommend on Friday, CNBC. What? I didn't get that in the different color here. We didn't. On Friday, they have a show called Options Action. I wouldn't take to heart anything they recommend, but it's got beautiful graphics. It's an educational 20 minutes. It's a good investment. But they have in there a Carter Braxton, who's their technical analyst. And technical analysis is for the stock. Makes a joke about calling to the charts. He says, let's call to the charts. So technical analysis is more for like options, more short-term oriented. And we're typically going to be using charts. And in the charts, what we're interested in is the price and time, right? So a chart will have vertically, the vertical line is typically the price, and then the horizontal line is time. And so we'd be using charts of price and time, and we'd be using a relative strength, trying to confirm whatever a trend that we think it is, bullish trend, a bearish trend, confirmation of that. We might place a sell stop or a buy stop, above or below, sell stop below the support line, buy stop above the resistance line to either go long or short. But, we're not really care here about, their products and services or the business cycle or the economy. Elon Musk of Tesla doesn't do this as often. I don't know if he's been counseled backstage, but, sometimes he doesn't talk about building cars. He talks about the supply-demand relationship of Tesla. And he says, people who short Tesla are not very smart because they don't realize there's a very small float. There's a very small supply of Tesla stock in the public marketplace because my millionaire friends and I own most of it. We control most of the float, the supply of that stock. And so that means it doesn't take many retail investors to buy Tesla. Again, demand for a finite supply of Tesla stock to cause it to go up. He says, I just love squeezing shorts in Tesla as much as building electrical cars. That's a technical discussion of Tesla stock price. That isn't a discussion about, the market for electrical cars around the world, and, the end of fossil fuels. That's a different thing, right? Now, a fundamental analysis is where we use some of that stuff from one of our previous explications. We make a decision about the economy, the industry, and then we're going to look at the company itself within the industry. And then we'll look at things like its balance sheet, looking for some hidden value there, maybe an income statement, maybe a statement of cash flow. We might make comparisons between its price to earnings ratio versus, other companies to see if we think it's undervalued or overvalued based on that PE ratio. So, the fundamental analysis is going to be a little more long-term focused, longer-term oriented than it is technical, right? I mean, it makes sense that, guys who are trading commodities and option contracts and things like that are more often practicing technical analysis than they are fundamental analysis. And then remember this, we talked about this in a previous explication. And the previous explication we talked about this one was in bonds and in analytical tools. So remember, we have this idea of discounted cash flow. What is the present value? Let me get it again. future income streams. So the first thing is discounted cash flow doesn't work on anything that has no income, right? You can't do a discounted cash flow analysis on a growth stock that has no dividend, for example. To be doing a discounted cash flow, so what I do is I say, okay, here's the sum total of all the future income streams or payments I'm going to get. For example, my Bank of America example, right? I'm going to say, okay, well, I'm getting what we think it was 21 cents times 4, 84 cents. So I'm going to get 84 cents from now until whenever. You know, it's not testable, but I'll either have a terminal value. Well, to do the math, I'll say for 20 years or forever and ever, I'm going to get to 21 cents and say, or excuse me, per quarter, 84 cents a year, and say, okay, let me pick a discount rate. Right now, this would be challenging because what kind of a discount rate are you going to pick, right? You know, a rate that you're going to use to figure out what that is. Remember, money today is always more valuable than money at some future date. And then based on doing that discounted cash flow, known as the dividend discount model, when it's applied to stocks, and that's what we're doing now, we're applying it to stocks, come up with what I think a present value number is. You know, Mr. Buffett is big on this, right? And he says, well, you know, if I'm going to get 84 cents in Bank of America from now till whenever, here's what I think the present value is of Bank of America. We just said it's $40. So if he does the discounted cash flow and it comes up in the Bank of America, present value is 38, why pay 40? But if the present value is 40 and the stock is 42, why do that, right? We'd want to be buying it for less than that. So 38 would be, you know, represent a good deal. 42, not so much. Again, I'm not going to make you do the math. It just, can you do it? Now, if Mr. Buffett or practitioners decide, let's just add one here. There's another version of this where we assume that the dividend may grow. And so we also have the dividend discount growth model. And that's where we make the assumption that Bank of America may raise its dividend. So, you know, we're getting 21 cents a quarter now, but who knows, the board could meet. I mean, it used to be 18 cents a quarter. So maybe they meet and say, hey, let's move it to 24 cents. Now, the only test question about a dividend discount growth model is where we assume the dividend is not a constant. But will rise over time. The test question there is we could justify a higher price that we would be willing to pay, right? It justifies a higher valuation when I'm doing the discounted cash flow analysis if I'm assuming that I'm going to get, a dividend that is going to grow. Okay, so I don't know. I'm trying to bring these things in. I don't know what I brought this in until I clicked the button. But we'll call it a day there. Let's see. We did 3 questions there that you could experience. We did 3 questions there. So 6, that's 6 questions. And then we did, so that's 8 questions today, 8 questions in today's test specification. So I'm going to put this on the channel and I'll probably set this to a premiere. So premieres mean that, you know, it'll have a date where you can watch it. And then I'll usually run the chat alongside that. So if you're a 65 candidate, feel free to join us for the premiere and like, subscribe, comment. And if you're not a 65, I don't know why you'd be watching this, but you could still join us for the chat. So maybe I'll make a separate invitation for the chat for people who want to join us for other things. Okay. Oh. That was the wrong one.